Good afternoon, all the Chartered Accountant members who joined this webinar. And my name is Rajat Agarwal. I'm a Chartered Accountant in practice. Firstly, I would like to thank our President, ICAI, CA Ranjit Kumar Agarwal ji, Vice President, CA Charan Jot Singh Nanda ji, and our CMP Committee Chairman, uh, Dr. Rohit Ruwatia ji, and Vice Chairman, CA Umesh Sharma ji. आज का हमारा जो टॉपिक है वो क्रॉस बॉर्डर टैक्सेशन पे है। और आज के हमारे जो स्पीकर हैं वो सीए मनीष अग्रवाल जी हैं। मैं इनके बारे में इंट्रोडक्शन देना चाहूंगा कि सर को 13 साल का एक वास्ट एक्सपीरियंस है इन डीलिंग इन इंटरनेशनल टैक्सेशन प्रैक्टिस, एंड ही आल्सो वर्कड विद बिग फोर, and he has a expertise in transfer pricing, modeling and dispute management, cross-border taxation, startup policy incentive and funding life cycle, and startup tax structuring. And he has also delivered many sessions in NIRC branches on NRI taxation, startup taxation, and transfer pricing. And he also participated in ICI hackathon on AI use cases, and he also worked with Big Four firms like RSM India on topic transfer pricing issues for foreign MNCs. And currently, sir is working with APAC taxation firm, which is US-based automation company and having presence in more than 57 countries. Now, I would like to request our speaker to deliver their session. Thank you, sir. Over to you, Manish.
Thank you, Rajati, for the warm introduction, and committee for members in practice and ICA for giving me this opportunity to share my knowledge and deliberate on this very insightful and hot topic currently. Uh, so share my screen and we'll begin from here. Is my screen visible to everyone?
Yes, sir.
Okay, let me just enter on the slideshow mode and we'll begin from now. So the agenda for today's session, I keep it very brief but very relevant, considering the current Indian startup ecosystem. We will see how the Indian startup ecosystem and the funding environment is evolving. Then we'll see uh, what are the kind of holding structures that are prevalent in Indian startups, be it internal structure, external structure, some recent trends in reverse flipping, types of funding instrument, and the exit options. What are the various exit options like sale, IPO, buyback, etc., and what are the key tax implications. Then we'll also see some of the transfer pricing issues, particularly relevant for the tech-based startups. Then we'll see the ESOP, because ESOPs are very common in startups and tech industry. So how the ESOPs are structured and what are the key tax implications for the employees and the employers, we'll see. Then also we will see some of the foreign tax payments, how they are taxed, like various digital payments, advertisement payments, marketing payments. What are the key tax implications? And then the next, which would be very useful and uh, evolving area for us, what are the opportunity for us as a professional in this area? So let's see first an overview of the Indian startup system and the trends in the funding and the investment landscape in the current Indian startup system. We can discuss any of the if someone can take a look at the chats, if there are any questions or any, we can take a note of it and we'll try to address it during the session or maybe at the end, but we'll keep it interactive and as open and dialogue based. So let's start with the current Indian startup ecosystem, how vibrant it is. It is currently one of the third largest startup ecosystem in the world, next after China and USA. So we are very much towards the path of the Viksit Bharat 2047 as per the Prime Minister's speech yesterday and the recent budget speech and the economy survey. Our economy is quite very well performing among all the major developed and the developing economies in the world. Our startup ecosystem is quite prominent in terms of the numbers. If you see, we have 68,000 startups launched till date. We have 110 startups in the unicorn, which means startups having valuation of $1 billion plus. A lot of positive indicators in terms of job creation, 768,000 plus jobs, 21 listed companies so far. Listed means like we have Zomato, we have Paytm, we have Policy Bazaar, we have many other listed large companies getting listed, and day by day we are seeing IPOs coming in for the startups. Combined valuation, if you see, is $450 billion plus. Funding is $115 billion. So these all numbers say that how vibrant and growing startup, and there is no sign that these numbers will slow down anytime soon, but rather they are expected to grow. So this is how vibrant and booming our startup ecosystem is. If we talk about the Indian economy development indicator, everything so far on the Indian side seems to be very positive, be it macro indicators, the GDP absolute numbers. We plan to be third largest economy by 2030. It's 3.18 trillion at the moment, but we will be 5 trillion as per the PM's mission in 2030, and by 2047 developed economy. Our GDP is growing at a fantastic growth rate, 6% over the last 10 years, but predicted for FY 24-25 is somewhere around 7.2%. FDI is also growing at a very steady pace of $84 billion last year. We got 100 billion plus in the latest fiscal year. So everything on the economic side also shows that India is a very uh, growing economy in terms of the consumption, in terms of the growth indicators, in terms of the macro indicator. This all places India a very target market for all the startups across the world and the Indian market as well because of the growing India story. And if you see the funding numbers compared to last 2-3 years, the numbers have been increasing and growing. Obviously, 2022 was the biggest year, but there have been some slowdown across the globe in 23 and 24. But still, uh, we are growing, and the funding is deals are happening. The focus on the deals have shifted more from just a valuation base, but more towards the profitability numbers. But still, the funding is happening at a slow pace, but quality deals are still happening. So deal size have been reduced a bit, unicorns have reduced, but still the deals are happening and at a very good numbers. We can see a healthy trend. If you see some of the top funding rounds, we would have seen in the news in the economic time front page, 600 million Zepto, FarmEasy, FM, Pocket FM, Shadowfog. So all this has been raised at a very healthy valuation, and a good set of investors are looking India as a right market in terms of investing. And in terms of the technology, we see diverse startups from the uh, like e-commerce, enterprise technology, fintech, health tech, clean tech like EV. So there is a healthy mix of the startups across various categories. So yep, the numbers are increasingly and the funding is on the right track. If you see some of the exits recently, like last week we saw the IPO of First Cry, Ola Electric, Unicommerce. They saw very healthy listing gains and exit at a multiple fold of valuation. So what all this demonstrates, a few slides that I have shown in the that Indian startup ecosystem is a very healthy ecosystem. It is a mature market. It not only shows that there is a funding, but it also shows that there is an exit also happening at a multiple fold of gains. So with this, we need to see that like these numbers we are seeing, but how the real mechanics works in terms of the taxation, because obviously these numbers are, if you're talking about $1 billion valuation, multiple crores of exits on the Indian stock markets, there has to be some tax implications around this because the numbers are significant. And for that, we need to be aware of certain basic principles, how these startups are structured, what are the funding instruments that they use, what are the exit mechanisms that are there, and the tax implications. So tax implications are always going to the basics of the Income Tax Act, but we need to look into the some specific structures that are in startups arena and will build upon on those concepts. So let us see the types of holding structure that startups are currently following. So there could be two types of structure. One could be India headquartered structure, and the other could be overseas headquarters structure. So when I talk about India headquarters structure, it means the operating entity and the main entity is based out of India. And when I talk about overseas headquarters structure, it means while the operating business entity would be in India, but the main headquartered entity would be somewhere outside India, let's say Singapore, Mauritius, Netherlands, or some UAE or some other preferred jurisdiction. But we see the pros and cons of each of the structure, and after that we'll see what are the recent trends in the holding structure. Yeah. So let's see closely some of the pros and cons of the India headquartered structure. So when I say India headquartered structure, it is typically favored when the promoters and the investors are mostly Indians. And when it's a purely a domestic business, there is less cross-border regulatory issues. It is simple and less complicated structure. And within India market, we have seen that in the recent past, the financial markets from a SEBI side and RBI side, there has been a lot of push to attract the foreign capital in the Indian structure, like liberalization of FDI in many of the sector, allowing non-residents to invest in gift city. So many of the measures have been taken which can promote the capital market buoyancy and raising the attractiveness of the Indian companies. There have been a lot of fiscal benefits in the form of reduced tax rate for domestic manufacturing companies. You have uh, performance production linked incentives, PLI for various sectors like EVs, for semiconductor. So there is a great lot of emphasis on creating structures in India from the government side to promote the Make in India agenda and to promote the domestic job creation. So India headquartered structure, currently the government is promoting a lot. Whereas what are the consequences of having a structure in India? First of all, uh, the tax laws, while we see that there are incentives, but implementation of, as we all know, is a bit challenging at times. The administration itself is a complex thing. So comparatively higher, and the laws at the times may be uncertain. There could be certain amendments which can, like the recent in the budget, we saw the indexation amendment. So there are uncertainty in the Indian tax legislation that we have seen over the past. Plus, certain areas where the foreign investors typically feel that India lacks is the IP protection regime. We don't have very strong IP protection regime like the other developed countries. Then regulatory regimes, particularly uh, foreign exchange laws, are very strict, and there is no very straightforward guidance on this. So there is also uncertainty over there. And apart from that, while India's ranking in ease of doing of business has improved over the past, but relatively there are a lot of areas which remains as an area of improvement, and work needs to be done, particularly on the GST side, on the income tax side. There are still a lot of areas where there are pain points. So these are some of the pros and cons, but I would say pros are outweighing the cons because the Indian markets currently have a very high valuation. They have a appetite for higher uh, IPOs, higher exits. So that is the reason many companies are now preferring the India headquarters structure. Now, if you see the overseas headquartered structure, if you see the on my right to the slide, we see like the business still is in India, but from a capital structure point of view and holding structure point of view, uh, there is a intermediary holding jurisdiction company which is based out of Singapore, and on the top of Singapore we have investors who are based out of US. So in this case, the business and everything remains same, but the holding structure, the investor do not come directly into India, but via a Singapore company. So the reason for coming from Singapore or for this overseas headquartered structure is because what are the consequence cons of India are the pros of the uh, overseas structure. It means Singapore is a very developed market. You have friendly laws over there, favorable regime over there, low tax burden in there, higher IP protection laws, developed capital markets. So typically these are the areas or reasons why it is favoring with the overseas investor. But again, the valuation is one thing which is attracting as of now the investors in Indian market. So the in Singapore, the option for listing and taking a significant listing gain is not as significant compared to India. So that's the reason we see people are now looking to a trend called uh, reverse flipping trend, a flipping trend. So in a flipping trend, we see people moving to a structure where they shift their headquarters from overseas structure, which we see, to India-based structure. Now, the reason for India-based structure is, as I mentioned, is again and again, is because of the higher valuations, and also in an overseas structure, there are certain tax risk, like round tripping issues from a FEMA point of view, then RBI additional compliances due to income tax issues like place of effective management. Then you also need to have a substance in place if you're having a foreign structure. You need to maintain the entity. You need to do all the local compliances in that particular jurisdiction, maintain the financial statements, get it audited, maintain a head office, maintain a staff over there. So all these compliance issues coupled with RBI round tripping and tax issues, companies are now seeing that there is no real advantage in terms of the tax as well, because most of the treaties are now getting amended with the change in the capital gains tax position recently. So to capture the higher valuation of the Indian market, many of the startups are now coming back to India and changing their overseas structure to India headquartered structure. Now, how they are doing it, what are the methods of doing it, and what are the tax implications of changing a structure from overseas headquartered to an Indian headquartered is something which is of interest, and we should look upon it because this is in the news and many large startups and everyone is considering this. So having awareness about these issues and the tax related aspects is something we should know. And what is the pushback or what is the trigger point for increasing in this reverse flipping trend is there are a couple of reasons, as I mentioned, that increased reform speed from the new government and tax incentives being offered in India and recent regulatory relaxation from RBI, SEBI in Gift City, production link incentives, angel tax removal, all these are attracting the FDI within the India market. Now, what are the common ways in which you can move back your structure from overseas structure to a India structure? One is your inbound merger structure, and other is a share swap or a share sale structure. So inbound merger is a structure wherein the foreign company gets merged into the Indian company straight away. So the foreign company gets dissolved and the only the structure remains, the promoters and investors and they directly become now the holder of the Indian company. So the foreign company gets eliminated from the structure in between by merging into the Indian company. So this exercise is typically a tax neutral exercise if we follow the regulations under the section 47 of the Income Tax Act. And there are also no gift tax implication because it is covered under section 56(2)(10) exemption. At the level of the shareholders, there is also no tax implication because merger is covered under section 47. From a regulatory standpoint of view, certain approvals may be required under the RBI cross-border merger regulations. And if we need a FEMA approval or a competition commission or a sectoral approval, these are the specific approvals that you need to seek. But from a tax side, purely speaking, this is a doable merger and companies are indeed doing it. We'll see this in a case study as well later. But this is the common route that is being followed by companies in moving their structure from overseas to India-based structure. Any ESOPs or that are already given to the employees of Indian entity for the foreign entity, it needs to be restructured and they need to be given afresh of the Indian entity ESOPs. There is another structure which is a share swap structure or a share sale structure, wherein the promoters and investors holding the shares of the foreign company, which in turn holds the shares of the Indian company. What they do is they sell their shares in foreign company against the shares of the Indian company. So again, the promoters and the investors becomes the direct holders of the Indian company, and the foreign company becomes a step down subsidiary of the Indian company. The foreign company would not have any business over there. It's just a empty entity or which can later on be dissolved or closed down. But it's more or less similar to what we done in a merger. But merger, as I said, it's a time-taking process because at times you would need approval of the foreign jurisdiction that is there. So merger involves a court approval process and it may take time. So depending upon the how planned, how well you are planning and the timeline you are for the exit, you need to plan the structure. Share swap as a is a comparatively a private transaction or a secondary transaction. It does not need some regulators approval or like a corporate approval, but it has a tax cost because uh, we may have, if you indirect transfer provisions under the law, wherein if you uh, sell the shares of a foreign company that derives indirectly more than 50% of their value from Indian asset, that transaction can be regarded as a taxable in India. This is post 2012 after the Vodafone Supreme Court ruling. So this structure is typically not favored because it has a significant tax cost involved over there. So yeah, now let's take a look at the very recent case study by one of a very prominent startup and group called PhonePe. So let's take a look at the background of these facts and we'll see how they move their structure from overseas headquarter to India headquarter. So PhonePe, they incorporated in 2015. In 2016, uh, PhonePe, they moved their structure initially to Singapore. Now, because after COVID and after demonetization, their India customer base improved very significantly. A lot of value is now derived from their India operations. So they decided that they should move their operations and headquartered back from Singapore to India because PhonePe is currently focusing more on India market. They are focusing more on the India digital payments, UPI revolution. And if they want to give an exit to their investor via IPO, it would be better for them if they have an entity in India. Also, from a regulatory reasons, RBI wants that financial technology companies or fintechs should have data protection laws and should have their servers in India, and there are other compliance related issues. So they want that PhonePe should be headquartered in India. So what they do is to move all their uh, requirements and to bring back the structure to India. PhonePe moved all the businesses and subsidiaries to India directly. So what they did is they in fact do a slum sale kind of a transaction. PhonePe moved all businesses and subsidiaries of PhonePe Singapore to PhonePe India directly. They paid the taxes on there, so they didn't go for a merger route, but they instead go for a share sale route, wherein the promoters of foreign company exchange their shares in lieu of the shares of the PhonePe India. So there was a capital gain involved, a significant, which was in the news, almost $2 or $3 billion tax that they paid on this entire transaction. But they moved the structure with tax because for them merger was not feasible. So key concept, PhonePe investors led by sold their stake in the Singapore entity and invested in PhonePe India. This means that there could be a capital gain tax in India for investor. So this was the structure that PhonePe followed. Now there are other news of startups looking for various options. We see a very prominent startup called Grow, Zepto, Misho, Pine Labs, Razorpay, they're all moving their structure from Singapore or other jurisdictions like Netherlands, they are US to India for the reasons because of the higher valuations and potential gains at the time of the IPO. So this is it on the first link wherein we covered the reverse flipping trade and the structure. Now I will look into the next part of our slides, which is the funding part. What are the types of instruments are there and the tax implications for them. So currently, for a startup or a private limited company or an unlisted company to raise a foreign capital, these are the funding instruments that can be selected upon as per the FDI policy and the FEMA regulations. Because whenever we are dealing with a foreign investment, we also need to look upon the FEMA regulations and the FDI policy. So the instruments that are currently permissible by startups to raise from foreign investors is equity shares, CCDS, meaning compulsory debentures, compulsorily convertible debentures, compulsorily convertible preference shares. Then there is a new category of instrument that is uh, applicable just for the startups is convertible note, which is similar to a convertible preference shares or a convertible debentures, but it has an advantage that at the time of issuance of convertible note, the equity is not immediately diluted, but it gets diluted, let's say, at a later point of time and as per the valuation that we agree now. So generally, it is a convertible instrument and it is the equity is diluted at the subsequent stage. Whereas in equity shares, if I give someone a straight away equity shares, my equity is diluted immediately. Share warrants are more or less a similar thing that you allot shares after 18 months point of time. But so these are the funding options or the instruments from which the money is bought in by the investors into the Indian startup: equity, convertible instruments, convertible notes, and the share warrants. Now, if we see if I bring the funding into India, what are the uh, key tax aspects, or from an income tax point of view, what are the potential areas if I were to advise a foreign startup or a foreign investor investing into India, what are the areas that I need to look upon from a tax point of view? And then obviously this is just a glance of the section. We need to look into the more detail for each of the particular regulation. But let's see. So first is section 56 to 7B, which is called as angel tax. As we all know, this section has been abolished from Finance Act 2020-24, which will be passed soon. But in the Union Budget 2024, it has been proposed that angel tax provisions will no longer be applicable. So for all the new startup fundraising rounds, this 56(2)(7)(b) would not be applicable. But there is another section, which is section 68. Section 68 talks about the source of the investor, how the funds, the source, the investor who is investing in India, whether the source has been appropriately disclosed somewhere, or whether they have the right amount of funds to invest in Indian entity through their balance sheets, through their tax filing. This is generally a pain point for Indian startups. Income tax department often try to send the notices to the foreign investors and ask for their balance sheets, ask for the documents from the Indian startup. But still, to verify whether the investor is genuine or not. But again, this section 68 second proviso is not applicable on the share application money or shares issue if it is to a non-resident. But if the money is coming in the form of debentures, bonds, or borrowings, then we need to prove the source of the lender. Now, whether transfer pricing provisions are also applicable on the issue of equity shares, preference shares, debentures, the answer is currently no, because these are capital transactions and the income is not chargeable to tax. So for transfer pricing provisions to apply, the transaction should be chargeable to tax first. Accordingly, in the Bombay High Court ruling in the case of Vodafone services, it has been clearly held that a transaction which is not chargeable to tax would not be subject to the transfer pricing provision. Now, the other provision which we need to see somehow is the gift tax provision. Whether section 56(2)(10), which is talks about receipt of any property at a consideration for a consideration which is less than the fair market value, whether it would be taxed, the difference would be taxed in the hands of the investor. The answer is yes. Section 56(2)(10) can be applied if I receive any property for a value which is less than the fair market value. But in the hands of the non-resident, we also need to see the provisions of the double tax avoidance agreements. If there is a in the tax treaties, usually there is a clause 21 dealing with the other income. So if the other income article of the double tax treaty from where the non-resident is coming gives taxing rights to India or to the resident state of the non-resident, this is something which we also need to see. If the other income article gives right to the tax to India as well, then section 56(2)(10) can be triggered, and the difference between the fair market value and the actual issue price in the hands of the non-resident can be taxed. But if the other income article in the DTAA does not give taxing right to India, and it gives taxing right only to the resident state of the investor, then it won't be covered by the provisions of section 56(2)(10). Now let's look at the taxability of the various income streams to non-residents. So the various forms of incomes could be interest or dividend on depending upon the instrument. So for equity shares, it would be a dividend only. We won't have any interest. So on equity share dividends, currently the tax rate for non-resident is 20% under section 115A or as per article 10 of the respective tax treaty. Under article 10 of TTAA, the tax rate is generally 10% in most of the treaties. For some treaties, it's 5% or 7.5%. But usually the tax treaty rate is more beneficial and it is taxable in the hands of the investor at the rate of 20% or treaty rate, whichever is beneficial. For the startup entity paying the dividend, they need to withhold the taxes under Section 195 as per the applicable rate under the DDAA or under the Act. While most of the cases we have seen that startups are loss making and they do not pay any dividend, but still for completeness purpose, I have included here. Similarly, on the preference shares, redeemable preference shares, optionally convertible preference shares, if there is any dividend payout, similar to equity shares, dividend is taxable at the rate of 20% under the Act, or if there is a tax treaty and the rate is lower than the Income Tax Act, a lower rate can be applied. The startup entity needs to withhold tax under Section 195 as to withholding tax. On the CCDS of debentures and bonds, if there is any interest that is payable, the interest is taxable under the domestic law, Income Tax Act at the rate of 20% under Section 115, or at the rate of 5% if it relates to infrastructure bonds or loans covered under the Section 194 LC or LD, whereas under the tax treaty, the general rate is 10%. So depending on the applicable situation, whichever is more beneficial, it would be taxed in the hands of the investor as interest income. For the entity issuing this instrument, the tax implication would be twofold. The interest expense that we pay to the debenture holder is deductible subject to 94B provisions, meaning if the interest is payable to any related entity, then the amount is restricted to the extent of your 30% of EBITDA. So, whereas if it is to an unrelated entity, there is no such limitation, but only in case of associated enterprises, there is a limit on deduction of interest payment. Any payment that you made would be subject to withholding tax under Section 194 as per the rates under the IT Act or under the treaty rate, whichever is beneficial. So let's see if a non-resident makes an exit. Exit means he go for a sale, redemption, IPO. What are the tax provisions or under the income tax law? What are the key regulations that we need to see to determine whether the transaction is subject to tax in India or not and what rates? So this is just a flavor that we need to see all these particular angles to analyze the exit mechanism for a non-resident and for the startup entity. So first is the indirect transfer provision. So what are indirect transfer provisions? Indirect transfer provisions, they were introduced in the law in 2012, wherein to cover the transaction of transfer of shares of a foreign company, which derives its value directly or indirectly from the Indian assets. So if somehow sometimes investors do not sell directly the shares of the foreign Indian entity, but they sell the shares of the foreign company that ultimately has a business in India. So to cover those transactions in 2012, law was amended to include the indirect transfer of shares as well. So this was famously capturing the impact of the Vodafone ruling Supreme Court. To nullify the impact of the Vodafone ruling, law was amended in 2012. And thereafter, subsequent amendments were made to insert the rules, and some cases, arbitration cases were also made in the case of Kane India, Vodafone India. There were many disputes over there, but the position of law is now settled that indirect transfer provisions are applicable if you transfer a share of a foreign company that derive its value from in India. Then also, if the transaction is purely driven by tax purpose and the sole purpose of the transaction to structure it in a particular manner is to obtain the tax advantage, then the GAR provisions are also applicable. So GAR provisions are very wide in nature. They can recharacterize any of your transaction. They can recharacterize any nature of your transaction, whether any tax, and even the treaty benefit can be denied if the GAR provisions are applicable. So as an advisor, we need to see what is the substance of the transaction, whether the transaction is uh, driven by commercial rationale or it is driven more from a tax point of view only. If it is driven completely from a tax perspective, then tax authorities can for sure challenge this under the GAR provisions. There have been very recently rulings where M&A transactions were challenged by the authorities, saying that the benefit of tax treaty obtained is solely for the purpose of tax purpose. It is a treaty shopping transaction and GAR principles can be applied. Then the next issue we need to see, if let's say investor is coming from a tax treaty country, let's say from a Singapore, wherein you have a lower tax rate or a grandfathering benefit. Now, whether at the time of exit, the benefit of lower tax can be given compared to the Indian capital gain tax rate. Let's say there is a 12.5% capital gain in Indian tax law now, but for Singapore treaty, the treaty provides that 50% of the domestic tax rate is applicable. Now, to get the benefit of the treaty, the lower rate, we need to prove that we are eligible for the benefit of the treaty and the entity of the transaction is actually a substance related transaction. The entity, the foreign entity that is selling the share is actually the beneficial owner of the share. The purpose of the treaty or the transaction is not to obtain just the tax benefit. So more or less it's similar to GAR, but we need to also satisfy the test under the tax treaty which is being prescribed. Also, when we do a sale per transaction or a exit transaction, if there is any transaction between the related parties, we need to see the transfer pricing side as well to make sure that the transaction is at arm's length. So how do we make sure that the transaction is at arm's length? To by having the valuations in place to show that the transaction is at correct valuations. There is no undervaluation or overvaluation for the purpose of shifting of profits. So transfer pricing comes in picture when we have a related party transaction. There is another section, section 50 CA, which talks about the transaction between of a unquoted shares. If there is a transaction of unquoted shares, the sale consideration is deemed to be the valuation prescribed under the income tax rule as per 11 UA. So, which is nothing but the book value method. So, if you are selling the shares below the book value method, the Income Tax Act will substitute the sale consideration to at least to the book value method. So, we need to also make sure that the transaction is happening at least as per the value of book value under the Income Tax Act. This is applicable only for the shares. Now, section 56(2)(10) is also applicable if we receive any property for a value which is less than the fair value. So in this case, 56(2)(10) also need to be seen. And for 56(2)(10), we need to see whether the transaction is happening at a value which is at par with the fair value under the Income Tax Act. So under the Income Tax 56(2)(10), fair value for 56(2)(10) purpose is the book value method under 11 UA. So 11 UA talks about the assets minus liability, the book value method. So this is how we need to see the various issues from a exit point of view. Now let's have a look at some of the specific exit methods and the tax implications. So before that, I've already spoken about on this the taxability of the capital gains and the DTAA, but just overview of the DTAA's, the capital gain clause, which is the most relevant in terms of when you plan an exit or when there is an exit transaction happening. The under the domestic law, the capital gain is chargeable to tax if the capital asset is situated in India. So if you are transferring a share of an Indian company, it is for sure covered as a capital asset situated in India. Also, if you're transferring a share of a foreign company that is deriving its value from in India, substantial value, then also it is a India capital asset by because of the deeming fiction created under section 214 and under section 9. Now, if you're coming from a treaty country, you need to see the relevant article of the tax treaty. Article 13 is generally the case, and we need to see whether uh, the source country has the right to taxation or the resident country has the right to taxation. In most of the cases, the source country, for example, if a Mauritius investor is selling the shares of Indian company, whether the capital gain would be taxable in India or only in Mauritius, that's the issue. So up till 2017, the taxing rights were not with India, but after 2017, the treaty with Mauritius, Singapore were amended, and India has been given the right to tax the capital gains on the transfer of shares of the Indian company. The tax rate is as per the domestic tax law for a period of, let's say, few initial period for investment made before 2017, there is a grandfathering given, that is no taxes applicable. For investment made after 2017, the capital gains are not taxable in India. But even for the grandfathering benefit, we need to satisfy the provisions of the GAR, and we need to have a valid tax residency certificate. We need to satisfy the conditions of the beneficial ownership. And very recently, uh, let's say in a month of April or May, we have seen that the Mauritius Treaty has also been amended to include the preamble in the treaty, which says that the principal purpose test of is the requirement which we also need to fulfill before a treaty benefit can be given. So principal purpose test is nothing but the same, that the main purpose of the transaction and for the treaty is not to avoid taxes, but the genuine economic and investment cooperation, but not the tax avoidance or tax evasion. Uh, There is a recently a controversy ongoing between whether investors in let's say a US based investor, uh, he holds the shares in the Mauritius company, and the Mauritius company ultimately holds the shares of the Indian company. Now, the Mauritius company transfer the shares of the Indian company, get the proceeds, and transfers the money to its US company. the the question here is let's say these investments were done prior to 31st of March 2017, meaning the grandfathering is available and there is no capital gain tax applicable as per the tax treaty. This is the position of the taxpayer, that my investments are covered by the grandfathering provisions and I should not pay any tax on the investments or the gains that I made from the transfer of the shares of the Indian company. Now, tax authorities generally say that this benefit of grandfathering is not available because the investments that the Mauritius entity has made is not the beneficial owner of the investment, because Mauritius entity is just the interposed entity or a intermediary entity with no substance of its own. It got the money from US entity to fund the investment in India. It has its no independent substance, no presence. The only requirement, just by having a tax residency certificate from Mauritius authority, does not mean that the Mauritius entity is the beneficial ownership of the uh, shares, and hence we cannot give a benefit of zero tax rate due to grandfathering. So the taxpayer challenged this decision in Delhi High Court in the case of Blackstone Singapore, uh, and the Delhi High Court ruled in favor of the taxpayer, saying that the requirement of the beneficial ownership is not applicable for a capital gain clause, but The matter is currently pending before the Supreme Court, so there is no final say on this matter, but sufficient to say that this matter is already has enough controversy, and due to the substance and the requirement of beneficial ownership. But as a tax advisor, we should always advise, or we should always uh, recommend that there should be a substance uh, at the foreign investment level, because tax authorities will always challenge the substance through one way or another way, through GAR or through treaty beneficial ownership. So it is always recommended to have a genuine substance and the commercial substance of the transaction, rather than being challenged by the authorities at a later stage. So let's see some of the exit options, the popular options, and the tax implication. So exit option means, let's say when an investor, every uh, investor in a startup comes with a particular investment horizon. Investment horizon means they have a particular time frame within which they want the exit to happen. This could be 3 years, 5 years. It depends on the fund to fund, but usually they try to get exit if they enter the company at a very initial stage, let's say at the time of foundation stage or at a very seed stage, they may stay early. But if they come at a later stage during the growth stage when the business is stable, they usually stick in the business for 3 to 5 years, and they take an exit through a sale to another investor or through an IPO route. And in case of preference shares or debentures, it could be redemptions, buyback in case of equity share. So these are the various modes wherein we can give us exit to a investor. So let's see the one of the most common route, which is the secondary sale or IPO route. So in an IPO, uh, if you hold the shares for, and the period of holdings and the rate is as per the new law, effective from 23 July 2024. So if, because before IPO, the shares of the company, startup company, is treated as an unlisted share. The period of holding relevant for considering long-term capital gain and short-term capital gain would be 24 months. So if the shares are for a period of less than 24 months, it is considered as a short-term capital gain, taxable as per the slab rates. If more than 24 months, 12.5% without indexation, without any foreign exchange fluctuation. Same is the case with the compulsory convertible preference shares. If this transaction happens between 24 months, it is short-term capital gain. After 24 months, it is long-term capital gain. For compulsory convertible debentures and unlisted debentures, there is a new amendment that has come in the budget 2024, wherein they are always deemed as short-term capital gains. But for listed securities, the period of 12 months is relevant if the debentures are sold after being listed. If they are sold after 12 months, it is LTCG, else it is short-term capital gain as per slab rates. And if there is any merger or a demerger, then this transaction is considered as a tax neutral transaction if the conditions of section 47 are satisfied. Similarly, for convertible instruments like a preference share or a debenture, at the time of their conversion into equity share, there is no tax implication, because conversion is just from one instrument to other instrument. There is no tax liability at the time of conversion of shares or debentures to equity. But when those shares are sold, then the tax implications at the time of sale of shares would be relevant. But at the time of conversion, there is no tax implication. We'll briefly see the amendment proposed by the budget 2024 in the capital gains relevant for uh, non-resident investors in startups. So earlier, there were three broad categories of assets based on which the period of holding was determined. It was 12 months, 24 months, and 36 months. 12 months was majorly for the listed assets like listed equity share, listed mutual funds, units of equity-oriented mutual fund, REIT, InvITs. For immobile properties and unlisted shares, it was 24 months, but for others like gold, unlisted bonds and debentures, etc., it was 36 months. So there were three broad categories. Now, all of them has been made as instead of three categories, two categories have been proposed. One is for listed securities, any listed securities, unit of mutual fund, unit of business. All the listed securities now come under the 12 months, and any other asset or any other unlisted securities, the period of holding has been determined as 24 months. Similarly, the tax rate has also been rationalized. Instead of multiple tax rate across long term, short term, a single rate has been proposed for long term capital gain, which is 12.5% for all the long term capital gain, depending on the period of holding, 12 months or 24 months. The capital gain rate for long term assets is 12.5% without indexation benefit and without any foreign exchange benefits. And for short-term capital gain, if it is a listed asset, it is covered under 111A, taxable at the rate of 20%. And other than listed asset, any short-term capital gain is taxable at the rate of slab rates. So a pretty simplified regime, but we'll see how the law evolves over the period. There have been interpretation issues and that will come to right. But so far, the capital gain regime the government has tried to simplify it and put it just the two broad rates for listed assets and for the other assets. Now, there has been one very interesting amendment that I would like to cover, particularly relevant for startups and non-resident, which is one of the prominent mode of exit which is given to the non-resident investor is in the form of the buyback. So buyback means company buy its own shares from the investor. This generally happens at a premium. And earlier what used to happen, the premium used to be taxed in the hands of the only the differential is taxed as a buyback amount. Let's say there is a $100 value of the buyback, and against that the investment value or the cost that the investor has paid is $90. So only differential amount of $10 is taxed as a buyback tax in the hands of the company, and in the hands of the investor this amount is exempt. But now what they have changed is the entire amount of consideration for which the company buybacks from the investor is taxed as dividend in the hands of the investor. There is no benefit given of the investment amount paid by the investor as a deduction from the cost from the from the buyback consideration. So the full amount of buyback consideration is taxable as dividend in the hands of the investor. There is no benefit of cost of acquisition. So this cost of acquisition would be allowed as a capital loss in the later years to the investors, which is pretty strange. Why this capital loss is not allowed immediately? It's not, I would say, fair. And the dividend income, which is taxed in the hands of the investor can claim the beneficial provisions of the treaty if they have the valid documents to claim the treaty benefit and they are the beneficial owner and they satisfy the other conditions for claiming the treaty benefits. So this is the summary that consideration received by the shareholders on buyback of shares is treated as deemed dividend. A new section has been inserted in the name of 222F, and buyback is considered as a dividend irrespective of whether you have accumulated profits or not. So this is another very strange point. The company that is the startup paying dividend is subject to withholding tax provisions. You need to withhold the tax under section 194. So the withholding tax rate would be the same as we discussed in earlier slide, 20% under the Income Tax Act, or if it is covered under the DTAA, the beneficial provisions of the tax treaty. Cost of acquisitions of the shares is allowed as a capital loss, but not at a deduction from the dividend. And capital losses are not allowed to be set off against any other income other than the capital gains. So this is one of a numerical example to demonstrate the situation before budget and after budget. So earlier, as I said that the amount that you have invested is allowed as a deduction, and only on the differential amount, the buyback tax is payable at the rate of 20% plus surcharge and cess. So it is a significantly lower impact. But now after budget 2024, the full amount of the sale consideration is taxed in the hands of the investor as per the applicable rate under the treaty or under the domestic tax law. And the benefit of amount that you have invested is not given immediately, but it is given in the form of a capital loss. So even after considering the benefit of the capital loss, still there is a higher tax outflow as can be seen in this example. So buybacks needs to be carefully planned now or structured in a manner that this tax outflow can be mitigated to a significant extent, and proper planning is required, whether it is should be planned as a dividend or as a buyback. So one needs to be very careful with the buyback transactions after the Finance Act 2024 amendments. Now let's see a very interesting area, and one of my favorite area is the transfer pricing business model. So we see startups operate typically in the initial stages, they operate in a very unorganized, I would not say unorganized manner, but they are not aware of these cross-border tax issues. They focus mainly on the business growth, customer acquisition, targeting new marketing, hiring, and all that. But when you grow business internationally and open up multiple subsidiaries, open up new geographies, the transfer pricing issues become really relevant. And if they are ignored, it becomes quite a complex affair. So all these transfer pricing risk and how the business is to be modeled from a cross-border point of view needs to be very thoughtful, and it needs to be discussed initially itself, because if the decision is deferred, it creates significant problems from a, because Indian tax authorities are quite aggressive in transfer pricing, and even globally as well. The transfer pricing is one area which is looked upon by the regulators across the world. So let's see one of the common transfer pricing models that are being followed uh, within the Indian startup sphere, and we see how it functions and what are the structures. Let's see a distribution model. So in a distribution model, let's say I'm a software company, for example, Zoho, and I have customers across the globe. Let's say I have customers in Australia, South Africa, Brazil, South America. So there is one way of doing business is I appoint my related party entities or my subsidiaries in each country. They perform the sales and marketing function, and they distribute my products globally in the geographies where I'm moving, let's say South Africa, South America, Australia. So these entities or the subsidiaries in multiple geographies, they act as my distributor. They perform my sales and marketing functions. They distribute products. So how they distribute product? They purchase the software licenses from the parent entity in India in their own name. They sell the software to the customer. They derive the consideration from the customer, and they pay back the cost, the product cost, which the Indian entity as a license fee. And the profitability that is retained by them in their overseas jurisdiction would be a return on sale model. Let's say I make a sale of $100 in South America or in Brazil territory. So I have a subsidiary Zoho Brazil over there. So, and Zoho India is the principal entity in India, which owns the IP and the license and everything. So Zoho India tells put a model wherein Zoho Brazil would obtain the software license from Zoho India. It sells the software licenses to the customers in Brazil for $100, and Zoho India tells Zoho Brazil that for software licenses, I have a cost of, let's say, $95. So Zoho Brazil would pay back $95 to Zoho India. So what is the remuneration or the income for Zoho Brazil is $5, which is its distribution income. Because distributor is not performing any significant functions, because the product is of Zoho India. The product risk lies with Zoho India. The main technology lies with Zoho India. So only for its sales and marketing functions and distribution functions, it is being remunerated at the rate of, let's say, 5% of the return on sale. So based on the transfer pricing functions and the models, we determine the remuneration model for the overseas entity. The other model, which is quite commonly followed in especially in tech or a product companies with focusing on global markets, but having the India as the research centers. So we have seen that many startups have kept their base in India in cities like Bengaluru as their captive R&D center. So these Indian entity, because of the talent and availability of the low cost talent, they perform their main product development and R&D functions in India as a service provider. They open up an entity in India wherein all the R&D and the product development functions are being performed. The software is sold, is developed for global market, let's say for US, and the IP of the software, the license is registered in a mature market like Singapore. So in this way, how the mechanics of the transaction works amongst each of the entity and how the you know how each entity is remunerated, we'll see. So the Indian entity is a cost plus entity, meaning that the Indian entity is not generating any revenue. It is performing the product development and R&D function, because the R&D may or may not result into a successful product now. We don't know. But since Indian entity is performing the functions, it is generally considered as a low risk entity, and it is remunerated as a guaranteed return as a cost plus. So whatever cost the Indian entity is incurring, it is remunerated at, let's say, at a markup of 15% or a 20%. So that 15% would become the PNL or the taxable income of the Indian entity. And generally, the IP owner entity pays for the R&D functions of the Indian entity. Now, the sales generally happens in the developed market like US, where the customers are based. So the US entity will get the customer revenue and it will retain over there. And the Singapore entity will charge a license fee from the US entity for the exploitation of the license, because the US entity is selling the software that contains the license which is owned by the Singapore entity. So the Singapore entity charges the license fees from the US entity, and the customer revenue is with the US entity. So this is how, in a three-tier structure where India is a captive entity or a low risk entity, is remunerated on a cost plus basis. The Singapore entity, being a owner of license, is remunerated for license fee as a percentage of, let's say, a sales. And the main entity or a customer facing entity, US entity, charges from the customers. So this is from a transfer pricing point of view. So in summary, I would say the takeaways for a transfer pricing is that the focus of the entrepreneurs and the founder is more on the business, but at the same time, we as a chartered accountants and trusted advisors, we need to ensure that the hard work of the company and the co-founder does not get into the tax leakage and the transfer pricing litigation. So there needs to be a careful thought and planning and strategy needs to be put in place from a transfer pricing point of view, because these are all critical and complex matters, which if ignored at an earlier stage could be a pain point for the company as well as founders, and the could lead to potential exit, because if there is a significant uncertainty from a transfer pricing point of view, the investors would also during the due diligence give a valuation discount. You would not be able to get a significant valuation as well. So transfer pricing is a area which we need to plan right from the beginning. Any operations or expansion in a cross-border territory you are making, we should inform our clients that the transfer pricing is an area which we should definitely look upon. Now, this area is also growing, the cross-border ESOPs. Uh, so cross-border ESOP, apart from like startups, as we say, is a very during the early stages of the business, they are uncertain business. They don't have a very certain revenue models. They don't have identified customers. So they are all startups in a very frugal stage. I mean, they are into a lot of experimental stage, R&D stage, tried and tested stage. But to do all this, they need to attract the talent. But at the same time, startups are generally low on capital or they have the budget constraints. So to attract the right talent, so startups generally offer ESOPs to the uh, employees. So ESOP, how it is beneficial for both company and for the employees, that for the company it does not entail any immediate cash outflow, but it is in the form of a future equity. Whereas for the employee, it is the opportunity for them to participate in the future upside, because if the valuation of a company or a startup goes up, they would be able to participate in the gains through the increase in the valuation of their ESOP shares that they will get. So this motivates them to perform and do the hard work, whereas also the company saves on the cash and they can utilize the cash more on the R&D side of the operations and the marketing side of the business. So this is how ESOPs work and the concept of ESOP. And we have seen that many of the Indian companies, they list their pay in the early days when if they were trying to list on the foreign stock exchange, let's say on the Nasdaq or on a London stock exchange, uh, the employees of the Indian entity get the shares of the foreign parent. Uh, let's say you would have seen many of them. Let's say uh, the employees of Google India, they receive shares of the foreign parent listed in US, Google Alphabet in US, or Microsoft employee. So many of the startups are following the similar structure wherein they list their entity in US, and but the Indian entity they have in India, they issue the shares of the foreign parent to attract the talent in India. So how the taxability of these kind of ESOPs works when the employee is in India, but the issuer entity is a foreign listed entity. So in this case, the tax implications are same as generally under the law. There are typically four stages of ESOPs. One is the grant stage, other is the vesting stage, and the third stage is the exercise, and the fourth stage is the sale. So at the time of the grant and vesting, there is generally no tax implication, because uh, at the time of grant, I just receive a agreement that if I fulfill certain conditions, I will receive the equity of the companies at a future date. So at the time of grant, there is no uh, asset that I receive. So that's the reason there is no tax implication at the time of grant. Similarly, at the time of vesting, I'm just performing the conditions, but I haven't completed those conditions to be eligible to receive that particular asset, which is the shares. So even at the time of vesting, there is no tax implication. It is only when I fulfill all the conditions of vesting and the grant, I become eligible to exercise my option and receive the share. So under the law, at the time of exercise, when I'm allotted the shares of the company, because at the time of allotment only I receive the asset, the benefit I get is the real. I get the real benefit. So it is taxed as perquisite under the head of salaries under section 17(2) on the at the time of the allotment of share. And how it is taxed as a perquisite? The differential between the fair market value as on the date of the exercise less any exercise price that I have paid. So in case of foreign listed shares, generally the FMV is the listed price of the stock as on the date of the allotment on the stock exchange. This is the practice that we follow. And the excess price is the price that is mentioned on the grant date. And when I sell these shares subsequently, the any value on which I paid the perquisite tax, that is the FMV on the exercise date, will become my cost of acquisition. And the FMV at which I sell the share subsequently would be my sale consideration. So the difference between the FMV on the sale value and the FMV on the exercise date is a capital gain, and on which I need to pay the capital gain tax. But uh, the compliance point of view, an employer has to deduct the TDS as a salary because it is a perquisite. I need to withhold taxes under the salary as under section 192. And to determine the perquisite, I need to also obtain as an employer a perquisite valuation report. Generally, in case of a foreign listed shares, the perquisite valuation report is more or less a table of the stock price chart of the days on which of a particular, let's say 6 months is generally considered as a valid period for a valuation report. So for 6 months, the employer usually obtains from a merchant banker category one merchant banker uh, a price chart downloaded from the stock exchange data. And this is because for the listed foreign shares, there is no price manipulation, there is no valuation required. But for an unlisted company foreign share, there may be some valuation required in terms of the DCF and assumptions. But for listed shares, it is generally the price quoted on the stock exchange. And from an employer point of view, there is also an issue related to the deductibility of the ESOP expenditure. So what happened is the shares that I issue, uh, from an accounting point of view, there is an expenditure that I debited to my books of account, because when I issue a capital, I didn't receive any fair value from the employee. I received the exercise price only. The exercise price is generally at a significant lower value compared to the current market value of the share. So the difference between the current market value and the actual price that I recover from the employee is an expense in the hands of the company. And this is considered as a deductible expenditure under section 37 by many of the courts, including Bangalore High Court, in the Karnataka High Court in the case of Biocon Logistics. There was a special bench ruling on the same matter. So the deductibility of expenditure of ESOP is a fairly settled position. There are certain adjustments and other caveats to this ruling, which if you read upon detail, you will find out. But as a principle, ESOP expenditure is a deductible expenditure. The other issue is generally that we are seeing most prominently after 1st of October 2023, the last year amendment, is the applicability of the tax collected at source provision. So uh, since the uh, money remitted as an exercise price for foreign shares is considered as an LRS amount, LRS meaning liberalized remittance scheme, the banks have been asking employers to collect TCS from the employees at the rate of 20% if it exceeds 7 lakhs, and up to 7 lakhs, it's 5%. So this is an increased pain point. I mean, a higher cost for ESOPs. The employees who want to exercise the their foreign shares, they need to now pay 20% additionally on the full value as a TCS. They can claim it as a refund, but it acts as a working capital blockage for the employees. From a compliance perspective for employees, they need to disclose these ESOPs that they have for their foreign listed companies in their foreign asset schedule in their income tax return. Some of the issues that I can discuss in broader detail here is taxability of ESOPs in let's say I am an employee of an Indian company. I I perform my services, let's say, for 2 years in Singapore, for 1 year in Hong Kong, uh, and 2 years again in India. And I get the shares of the foreign parent entity. Now, after 5 years, what is the proportion of the income that should be taxed in India? Is it the full value of the shares that I receive, or only the proportion of shares which relates to my services that I have been in India? The answer to this question is that we should apply the principle of proportionality, meaning that only for the period for which services have been performed in India should be taxed in India as ESOP perquisite. For other periods which I was not in India should not be taxed in India. Now, the second issue which I would like to discuss is whether there is a mandatory requirement or whether Indian company should be cross-charged for the shares cost that the foreign parent incurs, that is the expenditure on issuance of shares, whether it should be recharged from the Indian entity. The answer is yes, because unless the Indian company is cross-charged of the actual expense, the deductibility of expense cannot be claimed because there is then no actual expense, but only a notional notional expense. So notional expenses cannot be allowed in income tax. So there has to be a mandatory cross charge and followed by actual payment between the entities if the expenditure has to be claimed as a deductible under the act. Now, whether on the cross charge of expenditure from by foreign parent entity to the Indian entity, whether GST is applicable on reverse charge mechanism basis? The answer is no. This has been recently clarified by the GST Council and also in the subsequent circulars that ESOPs issued by the foreign parent entity to the employees of Indian entity is not taxed as a RCM under GST because it is a transaction in the securities. Now, we've discussed this, whether TCS is applicable. Yes, because it is the overseas remittance is covered under the liberalized remittance scheme. And on LRS, TCS is applicable at 20% on amounts above 7 lakhs. Now, in the transfer pricing model that we have seen, let's say in the previous slides, we've seen that if an Indian entity is considered as a captive service provider, it is remunerated on a cost plus markup basis. So whether that cost base should include the stock-based compensation recharge that we are discussing here, the answer is yes. The Indian transfer pricing authorities and tax authorities say that the stock-based compensation expense recharge should also be included in the cost base and the markup should be applied on the increased amount. Now let's see some of the digital payments because startups are now increasingly using the foreign vendors, softwares, and tools. And at the same time, Indian startups are also selling into their digital products into cross-border market. So we need to see what are the Indian tax implications of those foreign software payments under the Indian tax laws. So the payments can be broadly categorized as software as a service, platform as a service, infrastructure as a service, and database as a service. So we'll see what all these type of transactions are there. So software as a service is a transaction. Let's say uh, you simply subscribe for a tool and you get the access to the software using the login ID. Let's say Zoho accounting solution. It's a classic example of a software as a service. You buy the subscription and you get the login ID and password, and now do you get a accounting software service. You need not to save anything on your desktop. It's on the cloud system. The other is a platform as a service. Uh, a form of a cloud computing service with a I mean, it's more like a engineering platform that you get wherein you get to make operations. You don't perform any service, but it's more like a Azure platform. If you have heard about, like it's more of a security platform or a engineering platform, like development operation. So it's more of a more advanced version than a software as a service. You get the access to a platform of the software vendor. And the third category is infrastructure, like you get like a data center charges or a server hosting charges, wherein apart from the software, you also get the access to the physical infrastructure of the third party. Then there is a fourth category, which is database as a service. There are a lot of specialized database in the fields like oil and gas database or engineering database that startups may need to access the technical data. So to access those technical database, you need to pay a subscription fees to those foreign vendor. So this is the fourth category of payment. Now, how these transactions are taxed in general? In 2021, Supreme Court in the case of engineering analysis passed a landmark ruling wherein it was held that payment for software license to a non-residents that do not involve use or right to use of a copyright is not in the nature of software royalty under the double taxation treaty. Under the Income Tax Act, there is a deemed provision under explanation 4, which tax these software license payments as a royalty. But under the double tax treaty, Supreme Court concluded that if there is no use or right to use of a copyright, the transactions are not in the nature of royalty. So for each of these payments that we have seen, we need to see the agreements and the transaction between the parties, that whether there is any underlying copyright that is being transferred. We need to see the relevant clauses of the agreement, that who owns the IP. The consideration that I am paying is just for the use of the software as an access or for the copyright as well. So depending upon the rights that I get for in consideration for the payment for license fee, we need to see whether the payment is in the nature of royalty or not. And there is also a controversy now growing upon whether, if it is not in the nature of royalty, whether it can still be classified as a fees for technical services under the Income Tax Act and under the treaty, where we have the fees for technical services clause. The answer to this question would depend upon the old age principle of standard facility and versus a standard facility of the Supreme Court ruling in the case of Bharti Cellular Limited and New SkyCell in the Madras High Court, wherein the principle laid down by the Supreme Court is that if the payment that I am for the service which I am making is a standard facility, meaning there is no customization for me And if there is no human intervention involved in this, there is no fees for technical service element for it. But if the payment is for a service which is a customized service, or there is an element of human intervention therein, then the payments can be categorized as fees for technical services. So we need to apply the old principles within the lens of the new technological developments to see whether those principles can be applied, and after applying, whether we can say that it is a human intervention service or not, and arrive at a conclusion whether the payments can be considered as a fees for technical services under the Act. Even if we conclude that it is a fees for technical service under the Act, there are still double tax treaties like with US, Australia, Singapore, where we have a make available clause, where we need to see whether the provisions are make available tests are satisfied or not. And even if there is no make available clause in the FTS, whether if there is no FTS clause in the tax treaty, whether we could be covered under the business profit test or under the other income clause. So all these transactions and the relevant provisions of the DTAA we need to analyze, because we as chartered accountants are required to do a certifications in foreign remittances for Form 15 CA/CB. So the provisions of tax treaty needs to be very carefully analyzed before we do any certification and arrive at a conclusion on the taxability of these complex foreign payments. Now, there is also an equalization levy on the foreign marketing payments and digital payments to like Facebook, Twitter, or to Google. Before budget 2024, there was a 2% equalization levy as well on the e-commerce operator. So this was removed effective from 1st of August 2024. Now only 6% equalization levy is applicable. This is on the payments by Indian companies to foreign vendors for advertisements and marketing spends. So for e-commerce payments, earlier there was an equalization levy which was applicable on the non-resident vendors, but it is no longer applicable after 1st of August 2024. So in that case, we need to see whether the payment is taxable as royalty or FTS. This is the principle we discussed in the previous slide. So if equalization levy is applicable, then the royalty and FTS is not applicable. But if equalization levy provisions are no longer applicable now, we need to discuss and we need to deliberate more upon the royalty and FTS taxation principles. So this is the snapshot of India's regulations on the digital economy transaction. There is an equalization levy, which we discussed just now, the 6% equalization levy on the advertisements and marketing payments. Then there is another rule of significant economic presence. This is again a unilateral measure in the Indian law. It does not impact if you're coming from a tax treaty company. It says that there would be deemed to be a business connection in India if the number of customers in India exceed a particular threshold, or the download or usage of software or other, if it exceeds a certain threshold. The present threshold is 3 crores monetary value or 2 crore or 2 lakh customers in India. So if a foreign company has a 2 lakh customers in India, or it has downloads or value of the transaction exceeds 3 crore, it will be deemed to have a significant economic presence in India under the domestic tax law, but not as per the tax treaty, because tax treaty is not yet amended. Similarly, income from sale of data, India related data, is taxed as a business income in India. Again, this is a unilateral provision under the Indian law, not under the Indian tax treaty currently. Then there is a 194O TDS on e-commerce operator provisions. Currently, it was 1%, but now after budget, it's 0.5%. Similarly, under the GST Act, there is a OIDR, Online Information Data Access and Retrieval Service. There is a reverse charge mechanism, GST, on import of such services. Now, this is very interesting topic which I will be discussing now is the Gujarat International Financial Tech City. So, Gift City is attracting a lot of news these days, and we have seen a lot of foreign funds are setting up the fund houses in India for making investments in India because of the attractive fiscal incentives that they get here. Under the Gift City, the fund house gets a 100% tax holiday here in India. There is no GST on the fund management fees. There is no security transaction tax, commodity transaction tax, etc. There is no P risk being here. The infrastructure and the regulatory regime is quite conducive. You got all the regulators, a single window approval, which is IFSA. A variety of instruments are available to participate in the gift city. So, because of this uh, favorable regime and the tax benefits that has been given, gift city is attracting lot of foreign fund houses, and they are establishing their funds in India for making investments into India. Earlier, they were doing it through a foreign jurisdiction like Singapore, but now because of the gift city uh, favorable regime, they are setting up their shops in a gift city, Gujarat, which is a uh, deemed as a non-resident person under the FEMA law, and under the income tax, it has been given a SEZ or a special status of a tax benefit. So let's see some of the tax benefit that non-resident investors get if they come in via gift city for investments into India. So dividend income, first of all, it is taxed at a reduced rate of 10% instead of 20%. The interest income that is usually taxed at 20% is taxable at the rate of 4%. Again, uh, on the bonds, the interest income is taxed as 9% against the normal rate of 20% for non-resident. Also, for certain securities like derivative securities, unlisted securities, there is no capital gain tax and the exemption is there. There is no GST on transactions carried out in FISC exchange. Exemption from security tax, commodity tax, stamp duty on the. So even from an investor point of view, there is a lot of reduced tax rates, capital gain exemptions to make them become a part of gift city fund houses and invest into Indian market. Now, this is the last part, and where we can spend time and see what we have discussed so far, how we can make professional avenues for us, and what are the opportunities for us. Uh, so this is not an exhaustive list, but just a, uh thought fully food for thought for all of us, and we can definitely collaborate more and see what are the areas of opportunity. So first is of course, when a startup or an investor comes in, we can advise on what is the structure that they want to look for. It is an onshore structure or an offshore structure, that is India structure or a overseas structure, or we can give a comparative advisory report on what are the tax and regulatory advantages, pros and cons of each of the structure, what kind of structure they want to put in place, and we can help them in putting up the structure in place. Then, uh, at the time of the fundraising, we can advise on what are the various funding options that they have, what kind of instrument they can choose. We can provide uh, advisory for each of the instrument it would have at the time of issuance from a FEMA point of view, corporate law point of view, valuation point of view, income tax point of view. All these advisories we can provide, and the compliance support we can as a chartered accountant provide. Gift City, as we discussed, is a new area. There are various fiscal incentives available in Gift City depending on the instrument, the the kind of fund they are investing. It's a category 1 fund, category 2 fund, whether you are investing through a portfolio scheme or through a derivative scheme. I mean, there are a host of benefits and structuring avenues in Gift City. So we can study those provisions, and especially for NRIs and HNIs, there is a lot of options and relaxation from SEBI and FEMA point of view. So we can keep ourselves updated and of these developments and put up the uh, advisory piece uh, to our clients. Then the transfer pricing is another specialized area wherein for cross-border transactions and related party transactions, how the business model should look like. We can assist in putting up the transfer pricing policy, remuneration modeling, help them in benchmarking the transaction rates, putting up the documentation, the annual form 3CB, local filing, master files, and also during the audit proceedings in defense, TP litigation, we can also support. ESOPs is another area which we can help is drafting of the ESOP schemes, how the tax implication would work both for the employers and employees, compliance requirement under the FEMA point of view, what are the limits under the FEMA, how the FDI and the foreign ODI regulations would apply in the case of startups and for ESOPs. This is another great area. Regulatory advisory, FEMA is a whole together a great area. Uh, I mean, the FDI compliance requirements when we raise a fund, when a non-resident is exiting from the business, what are the FEMA pricing guidelines, valuation requirements, reporting requirements, compliance requirements. Uh, there are certain conditions in the agreements that we need to see. So all these conditions are there. FEMA advisory is a great area of practice. The other niche areas, maybe not related to pure tax and regulatory and FEMA, but like pitch decks, financial modelings and projections. So these are also some of the areas which we can assist from a cross-border tax advisory point of view. Okay, I think uh, time to wrap up my presentation, and I'm happy to take any questions that we have so far in the session or and with the concluding remarks.
I think Maniji, there are no such questions. It was a very wonderful session, and I would like to thank your valuable insights on various kind of business models on cross-border transaction, transfer pricing, equalization levy, gift city. So this will definitely enlighten the path of professional journey of all members. Thank you so much, Manishi.
Thank you. Thank you, Rajaji. Thank you, committee again and the ICM for this opportunity, and I look forward to your collaboration. Thank you.
Thank you.
Thank you.
हेलो
Yeah.
हाँ सेशन ओवर हो गया शुरू जी आई थिंक मनीष जी क्लोज कर दें
Yes, yes.
ओके
Thank you. Thank you. Thank you.